All right, guys, welcome. Today we're going to talk about all things loan, including FHA loans, conventional loans, and my favorite, VA loans.
You better get fired up.
All right, guys, welcome. Today we're going to talk about everything you're going to want to need to know when it comes to loans. This is for sellers, buyers, agents, anyone included in the conversation, right? I want you to know we got the comment section open, whether you're watching on Facebook or on YouTube. So if you've got questions that I'm not asking, feel free to punch them in. I can bring them up and we will ask Nate live. If it's after the show and you're watching this after the live, still feel free to put them in. I will take Nate and he can come back and answer any of these questions. Nate, I appreciate you joining me, my man.
Yes, always a pleasure to be part of the team.
Happy Friday.
Happy Friday, yes.
So listen, tell me a little bit about the difference between the three major loan types, FHA, VA, and conventional. As someone who's a buyer, maybe I haven't bought before, maybe I've only bought once before, why would I consider each?
Yeah, so the vanilla loan, if you will, the most common loan that you'll see people going for is the conventional loan. That's the loan that most people gravitate toward because it tends to have better rates, it tends to have better configurations, and in many cases, it tends to have a better payment at the end of the day. If your credit and all the other qualifying factors kind of lead you there. FHA loans are a great alternative to a conventional loan, and we're definitely going to dive into that a little bit more. And then a VA loan, those are reserved only for eligible active duty and no longer active duty servicemen and women. You have to qualify for that loan by putting the time in and serving our country. It's not available to everybody.
All right, so talk to me a little bit about some of the minimum requirements when it comes to credit scores, cash down, maybe my income. How does that work?
Sure. So let's start with a conventional loan. For a conventional loan, the minimum credit score is going to be a 620. So a 620 minimum credit score is what you're going to need. You can put down, depending if it's your first time buying a home, and the IRS will tell you, if you look at their definition of it, a first-time home buyer is somebody that has not owned and occupied their primary residence for 36 months, 3% minimum down payment for that. If you are somebody that's owned property within the last 36 months and lived in it as a primary, then you only have to put down 5%. However, if you put less than 20% down, you're going to have what's called private mortgage insurance.
Now, you're bringing a private mortgage insurance or PMI. What's the difference between PMI or I've heard MIP?
Yeah, so PMI, private mortgage insurance, is what it's called on a conventional loan. And that's truly an insurance policy that we are required to have you take out that has an annual premium that's going to be based on a myriad of factors, but primarily going to be based on your credit, your debt to income, and things like that. PMI isn't necessarily a bad thing. If you don't want to put 20% down, if that's really going to deplete your assets, there's advantages to having PMI because it saves some of the cash you have in your pocket to be able to do the things that you want to do. Maybe you want to put a new kitchen in. Maybe you want to paint the house. Maybe you want to buy a great, furniture set that you saw somewhere. So there are advantages, and it's not a bad thing. PMI will drop off at one of two periods. Either when you get to 80% loan to value, which they say could happen within a couple of years, there does have to be some compensating factors like the appreciation that we're seeing today. You can't just ride the appreciation wave and then say, hey, I want my PMI to drop. There has to be something that you've done to improve the house as well. Yeah. So it could take 3 or 4 or 5 years for you to get there, but over the course of that time, do something to update it, whether it's new floors, new kitchen, bathroom remodel, something like that. Or if you don't want to go that route and raise your hand and say, take it off, it'll fall off automatically once you get to about 78% loan to value, which forecasting says is going to be after you've made 120 payments or after about 10 years.
Okay. And just to clarify for everybody, this insurance is something that Nate's not excited to add on to your loan. He doesn't want to add it on either. But from the bank's perspective, they're thinking if you've got 20% down, the likelihood you're going to default and we're going to lose as a bank is this big. But if you're putting down 3, 5, 10%, now their risk goes up a little bit.
Yeah.
So to compensate for that, they're going to take a little bit extra money from you in MIP or PMI to compensate for that average loss over a myriad of people, right? A lot of different people included. So that's why you've got that. And that's why once you get up to 20% in equity, whether it's from day one or after 3, 5, whatever it is years, you're able to get rid of that. So I thought that was
exactly right.
Let's get into some of the myths. Go ahead.
Oh, sorry. I was going to answer the second part of that. So MIP, mortgage insurance premium, is the same flavor, but it's on an FHA loan. There's differences, though, when it comes to MIP. So MIP is going to be a static percentage. It's going to be 0.85% of your loan amount before, and it's not going to change. It doesn't matter if your credit scores in the 500s, the 600s, 700s, or 800s. That's what it's going to be. It's going to be 0.85% of your loan amount. And it doesn't ever come off. Once you have an FHA loan with MIP, you're going to have that MIP until you refinance, with one exception. If you put down greater than 10%, so if you have an FHA loan and you're only financing 90%, after 11 years, it comes off. But the fact of the matter is that 99.99% of FHA loan borrowers are not putting down 10%.
Yeah, I assume, in my experience, they're all putting down 3.5%.
Yes, sir. 3.5% is the minimum down payment on an FHA loan. Even if you're not a first-time home buyer, 3.5%.
So I'm getting a little off topic here, but now my brain is clicking. As a lender, are you prospecting and looking for FHA loans who have been in for maybe 3 to 5 years but didn't put down that 10% for a refi?
Of course. That's absolutely part of our prospecting. We want to help those people. Is there an advantage to us? Absolutely. There's an advantage to us because we're doing our job. We're making our fee, if you will, but I'm helping them too, because if they've been in that house for a period of time and they've done the things that hopefully their mortgage broker or mortgage lenders told them to do, they can get out of that FHA loan and get themselves out of that PMI or MIP rather on an FHA, and they can get themselves into hopefully a better financial situation.
Sure.
They've gotten some equity now. Maybe they can consolidate some debts. And all in all, their mortgage payment may not shrink. It may go up slightly, but at the end of the day, they're saving money every month because they've consolidated some debts possibly. Yeah. There's always alternatives to where you are now. You're in this station for the time being, but me and my team and hopefully everybody else is working on a long range plan. This is not a one and done for us. We want to help you build wealth and acquire wealth through the real estate that you buy.
So I want to focus on the point of view of home sellers and listing agents right now, talking about some of the myths.
Yeah.
If I get 2 offers and they're exactly the same, both of them, let's say, have 5% down, one's conventional, one's FHA, everything else is the same. They've got the same proof of funds. They've got the same inspection. Everything's the same. The thought is, from a seller's point of view, FHA is a lower quality buyer than a conventional buyer. From your perspective as a lender, how much truth is there to that?
Yeah, that I would say that as a financial guy, I would say that there is a little bit of truth to that for sure. Everybody has, some bumps in the road, and every now and then they might put themselves in a situation where possibly they have a medical collection or something on credit that just has dinged them enough that they are now like a, scratch and dent, if you will, when it comes to purchasing. But I can tell you at the same time that some of the FHA buyers that I work with are in some cases just as creditworthy as the other guy. Like I said, there's some things that come our way from time to time. Life comes at us fast. That we do have some credit hiccups, and those things possibly prohibit us from being a quote conventional buyer. But so those buyers are typically and traditionally the more credit challenged people, and the expansion of their DTI also, some people look at that as a negative. It's not necessarily a negative. I can explain to you in so many reasons why having an expanded debt to income ratio for an FHA loan could be an advantage for the seller and the buyer.
Oh, big time. Yeah. So talk to me about, and you brought up at least one. Maybe you brought up both and I missed it. What's the minimum credit score for conventional and what's the minimum for FHA?
Sure. So conventional, we said, was 620.
Yep.
FHA actually has no minimum credit score. So FHA, Federal Housing Administration, it's a government entity, obviously.
Yeah.
They insure and guarantee the FHA loan. They say 500 is the bottom line. Now, you'll find that many lenders have an overlay, and an overlay is just something that a lender imposes. Added
restriction, yeah.
Correct. So most lenders have an overlay that says that their minimum might be 560, 580, whatever the case might be. As a broker, I have access to a lot of lenders, and not all of them are at the 580 or 560. But I can tell you that if you're borrowing under 580, you are required to put 10% down.
Yeah. And your terms other than that are a little bit worse too, right? I assume the rate's a little bit higher. Yeah. Okay.
Yeah. Listen, if your credit's worse off, you're not going to get the same or better terms as the guy who has the 580 credit score. That's just a fact. But yeah, 580 minimum and 3.5% minimum down payment if you have a 580 or higher.
Okay. So another concern of sellers and listing agents is if I'm taking on the FHA or even VA buyer, right? Because they're both backed by government, whereas conventional is private. You've got that more challenging appraisal that falls through more often. Is that accurate or inaccurate?
You're asking a mortgage guy, so I'm going to give you a mortgage answer. They're a little bit more in depth. So an FHA buyer, there's going to be things that the appraiser is asked to do on the appraisal that they're not asked to do on a conventional loan.
Give me some examples.
Just a few of those things are an FHA appraiser is they have a little tool and they're going to check every electrical outlet to make sure that the amperage and everything is correct. Okay. If it's over amped or under amped, they're going to call that out. They do a test of the HVAC system. They do a test of the plumbing. And then they do a spot approval, if you will, because they're not going to get on a roof, but they'll stand in the roadway and they'll call out certain things about the roof. Whereas on a conventional, they may not do that. So again, as the mortgage guy, this is my mortgage answer. My thought is that if you're concerned that a VA or an FHA appraisal is going to ding you, then it's possible before you list your house, you just want to do a quick spot check and make sure that those things that may get dinged are a non-issue.
Yeah. And I'll tell you, I looked back at, now some of these are going to be cash, right? But I just looked back at 100 sales and we had 11 fall short, which is a completely different issue. But we had 1 out of 100 that actually had an issue that had to be repaired, right? And it was FHA. But I think a lot of people believe that it's this really high percentage, and it's not.
No.
Does it happen? Yes. Does it happen at a higher rate? Yes. Is it this much bigger rate? No. It's very, very, very small.
Right.
So I think that's a great point to make. Now, some people are going to be approved for conventional, and they'll even give me, as a listing agent, a pre-approval that says conventional. But then in the offer, they're FHA. Why would someone have the ability to go conventional but choose to go FHA?
That's a great question. And that goes back to just some of the ways that those two loans are constructed. So FHA is going to give you an expanded debt to income ratio and allow you to have a lower credit score. And typically, depending where you fall, the rate could potentially be a little bit better as well. So we always look at a conventional and an FHA, and then the buyer kind of decides which of those makes the most sense for them. So in terms of a conventional loan, your debt to income ratio caps out at around the 43, 44%. And that's just if you're kind of redlining it a bit. FHA can go up into the mid 50s. Credit score requirement, again, FHA is going to be down into the 580 range for 3.5% down, where conventional is going to be at least at a 620. But if I'm a conventional buyer and I have a, say, 630 credit score, I'm not going to have great rates. I just won't, because I'm at the bottom of the conventional barrel, if you will. So an FHA loan is going to look much more attractive monthly in terms of what my payment is.
Yeah.
If you recall a few minutes ago, I was saying that the PMI on a conventional loan is based on your credit. So you're going to have a higher rate. You're going to have a higher PMI. So the house costs the same, right? We're not going to change the cost of the house depending on the financing. But your payment at the end of the day is going to probably be higher on a conventional than it would be rather on an FHA, because of the fact that the FHA has typically better rates, that fixed MIP amount, and the expanded guidelines. Somebody just may have a much better payment at the end of the day. I mean, I've seen it where it's been, $100 better, and I've seen it where it's been a couple $100 better. So it's just more of an advantage to that buyer, clearly, to have the lower payment. Same house, same everything else, but their mortgage payment's going to be less.
So you've talked about with VA, you're putting 0% down. With FHA, you're looking at 3.5%, and with conventional, it's 3 to 5 on the lower end.
Yep.
But we've got closing costs involved too. You've got inspections, you've got appraisals, you've got a million other things. What am I, as a buyer with each of those 3 loans, looking at out of pocket as a minimum, just to give the audience a little bit of an idea of how much they need to save up before they start having a conversation?
Sure. So between the 3 of them, there's not going to be a huge swing in out-of-pocket expenses. Depending on what county you live in Florida, your FHA and conventional appraisals are going to be at a particular point, and your VA is potentially going to be at another point. VA appraisals are the only appraisals that are actually ordered directly through Veterans Affairs. We don't order them through a local appraiser. Now, do they go to a local appraiser? Yeah, of course they do. But they're ordered directly through the VA web portal, and they set the fee. And that varies by county. I can tell you that in Brevard County, it's a little bit less than it is in Indian River and Stewart and St. Lucie and Martin. It's a little bit more. It's just, I don't make the rate payments, but it's a little bit more. So what was the question? I'm so sorry. I was going off on the VA.
No. Talk to me. Looking at the minimums, right? 0 down on a FH or a VA, 3.5 on an FHA, 3 to 5 on a conventional.
What are the out-of-pocket?
Some people think that's it.
Yeah.
So they think, hey, if I'm VA and I come in at 0, I'm good. If I'm FHA and I come in at 3.5, I'm good. And that's not necessarily the case, because you've got the inspection, the appraisal, title, all these different things. So when you add in all those closing costs, if I'm a new buyer and I'm looking at each of these 3 loan types, what's the amount of cash I need in the bank before I give you or me a call and start this process?
Yeah. So down payment aside, when we're just looking at cash to close, I always tell buyers to expect anywhere between 4 and 5% on the high end for what they need to have set aside. So if you're buying a $300,000 house, at a minimum, you're going to want to have about $12,000 set aside, but you'll want to have up to possibly $15,000. And I can tell you that the bulk of the fees and costs when it comes to getting into a home, if you're financing, is going to be third-party expenses. So if I'm buying a house from Joe Rosen at 123 Main Street, that house is going to have the same costs because you're going to have it with the same settlement or title agency. The taxes are going to be exactly the same. Your homeowner's insurance quote is going to be exactly the same, no matter, if you're using Bob's Mortgage or, the Nate Jomaa mortgage team. The difference when it comes to cost is going to be the lender fees. And then on a loan estimate, you're going to be looking in box A. So box A on a fee sheet from a mortgage company is going to be the difference maker. In theory, if somebody is being completely honest and transparent, all of the other fees should be the same. Because again, regardless of if you're using ABC Mortgage or the Nate Jomaa mortgage team, all those other fees are completely outside of our control, and I can't influence them, right?
Yep, that makes sense. Okay. So you're saying 12, well, let me go back to a percentage. You're saying 4 to 5% plus their down payment, correct?
Yes. In theory, that's what you should expect. That's not going to be an exact science every single time, but
and also from my perspective, that's a very high-end conservative number. So if you guys have that amount in the bank, you're looking solid, right? And that number 2 has a little bit of cushion. You're going to have some issues 2 months, 3 months into home ownership. Welcome to owning a home, right?
Yeah.
You're able to cover some of those things. So I think that's an excellent recommendation. So with VA, there's a funding fee. It's a pretty big fee, or at least it can be. It can be 0. Talk to me about what that funding fee is. Why is it in place? And how much can I expect to pay as a veteran for that funding fee?
Sure. Great question. So veterans have the option to put 0% down on a mortgage, and they do not have mortgage insurance. So they do not have PMI. They do not have MIP. But the VA does say that there's a one-time cost that must be paid upfront for veterans. And the only exception to the rule is if they have on their certificate of eligibility a notification that says that they're exempt because they have a service-related disability and they're graded disabled 10% or greater. So if they are eligible to receive VA disability benefits because they have a service-related disability, then they're exempt from the funding fee. Those who aren't, there's two different ways that the funding fee kind of falls. There's going to be first use, which of course is the first time that you're using your VA, and then there's going to be subsequent use. If you are purchasing a home, let's start with just first use, and you're putting $0 down, then your VA funding fee is going to be X, and it changes every year. So depending when you're watching this video, it's not going to be exactly the same, maybe in 2023 or 2024, because it changes, but it's going to be X. If you're putting 5% down, that's a little bit less, and it's based on a percentage. And then if you're putting 10% down or more, it's even less than that. And it's going to be a percentage of the purchase price. And that VA funding fee can be paid up front. It's hardly ever paid up front. What most people do is it can get financed with your loan. So if you're going to buy a home for $300,000, your VA funding fee is going to come out to be somewhere around $7,000 or $8,000 when it's all said and done. You can pay that out of pocket, or you can go ahead and finance it. And so your loan, instead of being $300,000, is going to be $300,000 plus whatever that funding fee comes out to be.
Okay, so let's say the funding fee is $8,000. Do I now have to get appraised for 308, or can I get appraised for
You have to get appraised for 308.
Okay, gotcha.
Yeah, so it increases the purchase price of the home.
Yep.
Right. You're purchasing it at 300, but you're borrowing 308.
So let me ask you this: you had talked earlier about being a first-time homebuyer, and the definition of a first-time homebuyer is somebody who occupied a home that they owned for 36 plus consecutive months. Is that correct?
Within the last 36 months.
Within the last 36
how the IRS has it.
Gotcha.
Defined.
And is that the determining factor between whether or not I can get a conventional at 3% versus 5%?
It is.
Gotcha. Is that the only determination between whether I can get 3%?
Yes, because a first-time home buyer, when it comes to a conventional loan, rather, is going to be either at 3%, or if they're not eligible for the first-time buyer, then it's a 5% minimum down payment.
Gotcha. Okay.
On a convention, on a single-family residence, when it comes to condos, and there's different configurations. So again, just the rule when we're talking through this is going to be a single-family residence, which is just your standard, home on the street.
So I got a lot of circumstances where we've got some people tight on cash, and I've been talking to them for months, maybe a year or two. All of a sudden, they call me out of the blue, Joe, we're ready to go. And I'll say, okay, so you've got the cash? Oh, yeah, we get the cash. We're good to go. And then all of a sudden, I start talking to the lender, and they're like, well, they got the cash, but it came from their uncle, and it was $15,000 that was just put in their bank yesterday, right? Mm-hmm. And sometimes that can be an issue. Talk to me about why that would be an issue, and what does seasoning funds mean, and how would that apply to me? If I know what seasoning funds means, how can I use that to my advantage as a buyer?
Sure. So that's a great question. When somebody's getting a gift from a family member, and for most of the loan programs that you're going to encounter, it's going to have to be from a family member. It can't be from, your neighbor next door or your deli clerk, at Publix. It's got to be somebody that's related to you either by blood or by marriage or adoption. So you can get a gift from them. And what happens a lot of times is they'll either write a check or they'll deposit cash into that account. And while that seems like a logical thing to do, it does cause additional work. And in some cases, if it's a cash deposit, there's no way for us to be able to source the funds, and we have to exclude that amount. So if you're already a little bit tight and you get a deposit from Uncle Joe and he gives you $15,000 cash, we don't know where that money came from. And we're going to exclude that money. The workaround for that is if it's going to be a check that gets deposited, be prepared for the mortgage company to ask for evidence of where the check cleared, meaning we need to get their bank statements to find out exactly where they got the money. And so it's going to open up a little bit more of a box, and we're going to ask a lot of questions. The easiest way to do it to avoid that on a conventional loan specifically is to have that gift wired directly to the settlement agency, because then the settlement agency confirms that it's been received, and we don't have to go through the verification process on the mortgage end of things. On a conventional loan, that's how that works. FHA and VA, we still need to source it, and we still need to find out where the cash came from, and it's almost impossible to source cash. So your other question was about seasoning of funds. So we ask for 60 days of statements for all of your asset accounts, whether it's checking, savings, retirement, brokerage accounts, investments. We want 60 days worth. And if we see inside of 60 days that there's a large deposit, we're going to ask where the money came from. And if we see that there's no way to verify that, then that's going to be a bit of an issue, because we'll have to exclude that money. So seasoning of funds just means that it's been there for at least 60 days. So when we get your bank statement, as an example, that bank statement's going to show us that those funds were already there and already seasoned. So we're not going to go back further and say, where did you get this money? Because at that point, it's a non-issue.
So if I am a very organized buyer and I'm out 3, 4, 5 months from buying, the smart thing to do is find Uncle Joe at least 60 days before I'm hooking up with Nate, get that money in my account. And now when Nate sees it and it's been in there for 60 plus days, there are no questions asked. Is that correct?
That is correct.
Awesome. So how much can be gifted to me as a buyer?
There's really not a maximum in our eyes on what can be gifted as a buyer. You're going to, at some point, and I'm going to say this is my asterisks that I'm not an accountant. At some point, you're going to hit what's called the gift tax, and that changes annually as well. So for 2022, the gift tax amount is about $16,000. So if I was going to give you, Joe, $16,000, I could be exempt from being me, not you, hit with the gift tax.
Yep.
So one individual is able to receive up to $16,000 from each person. So if you wanted to get, say, $32,000, Joe, all you need to do is get 2 donors that are eligible donors, and they also can give you that cash, and then they've kind of hit that ceiling before they're imposed the gift tax. So that's a strategy that we employ.
Now, Uncle Nate could give me 32 grand, but you're only going to get the tax exemption on the first 16, correct?
Again, I'm not an accountant, but that's the understanding that we have. Yes.
All right. Okay, cool. So what costs can be covered by a seller and what can't? And before you answer, a lot of people think, well, I can just get the seller to pay for my closing costs. I'm good. I can come in 0% down. Talk about that a little bit and what that means for VA, FHA, and conventional separately.
Sure. So I'll start with conventional. Any interested party contribution, IPC, is going to be capped at 3%. And an interested party is going to be the seller, both sides of the real estate transaction, and the mortgage company. They can only gift, if you will, a maximum of 3% total. So if you're going to get 3% seller concessions, then that means that you can't get any other payments or concessions from any other interested party within the mortgage. FHA, same story, but it's 6%.
Gotcha. So my closing, so essentially, if I can talk a seller as a buyer into paying for all my closing costs as a VA buyer, I can probably get in with no money out of pocket, assuming I'm a good negotiator. Is that correct?
VA is a little different. Yeah, VA, it doesn't necessarily impose the same concerns with that. So conventional is 3%. FHA is going to be 6%. VA is a 4% cap, but it's not necessarily viewed the same way. There's no cap on the amount that the seller can give to the veteran to pay for certain things, but there are some things that are capped, or rather are included in that 4%. And it's better to just talk at a 1-to-1 so that we can look at everything individually.
So let's talk about FHA. FHA is 3.5% down. Let's just say closing costs are 4%. That's 7.5%. You're telling me 6% can be covered by a seller. Does that mean I only got to come to closing with 1.5% if I can negotiate that?
In theory, yes. We need to see that the 3.5% is your funds. But if the seller's giving it to you, guess what? It's yours now.
Gotcha.
So it does need to be your funds. So if it's not coming from a seller, or a buyer, or sorry, if it's not coming from a seller or somebody else, we need to know where the 3.5 is coming from. But if it's seller concessions, that's your money now.
So you are a broker.
Yep.
And you've got a lot of different things that you can do that if I were to go to maybe a Wells Fargo or a Gateway Mortgage, it'd be a little bit different scenario. Talk to me why I'd want to call you over, say, a Wells Fargo.
Sure. So any of those standard institutions like Wells Fargo, any of the banks, any of the credit unions, and any of the direct mortgage lenders, they're a captive audience for their own mortgage programs.
Yep.
They can only lend based on their programs because they are the direct lender. The advantage of working with a broker like the Nate Jomaa mortgage team is that we're connected with, in some cases, dozens of lenders, and we're able to go and find these unique programs and whenever the case causes us to do so. But even for just your regular conventional FHA and VA, we've got multiple outlets to be able to make sure that we're getting you not just the best rates, but also to get you with a lender that's going to be able to get you through closing without any headaches and hiccups. And we are your trusted source, and we handle all of that for you. So instead of you going and talking to 10 different lenders, we are talking to these 10 lenders for you. So you have a single point of contact that's basically handling all of that for you. And you don't pay us directly. The lenders pay us for delivering the loan to them, which is fantastic for you because you don't have to take your time and energy and go talk to 10 different lenders. Let Nate Jomaa do it for you.
And there are so many different scenarios with people, right? Everybody's got, this one's got great income but bad credit. This one's got great credit but low income. This one's got both. This one's got neither. And you're everywhere in between. And if you go with, I'm going to keep picking on Wells Fargo. If you go with a Wells Fargo, they're good at that one thing, right? Yeah. Whereas Nate's favorite lender that he's using, if they're not good at that thing, he's got other people he can go to select something. So for me, I've always used brokers. I don't know why anybody wouldn't, but I think a lot of people just don't understand how the game works, right? But I think that that's a really big distinction to make for a buyer coming in and shopping their lender. So the last thing I'm going to ask you, this is kind of two things in one. Talk to me a little bit about 1099 folks, right? They're not on a W-2. They're getting paid with 1099 income. And also, I'll use, like, I've got a lot of great friends who are small business owners, and I get this call once a week. Joe, I'm ready to get pre-approved. I made 200 grand last year. I made 200 grand the year before. Great. What do your taxes look like? Well, you know, I claimed 60 last year. I claimed 70 the year before because a lot of that is cash under the table. Talk to me about my options for those buyers.
Sure. So it's very clear. We either look at 24 months of income as reported to the IRS. So if you're self-employed or 1099 or whatever you are, however you show your income, regardless of how you show it, if it's a K1, an 1120, 1120S, 1040s, I mean, the whole gamut, whatever it is, we're going to take 2 years and we're going to average it in many, many cases. So if we're only showing, because you've only reported to the IRS that you've made that $60,000, it does not make any difference what you actually made if you made $200,000. That's very simply, that's what we look at. Alternatively, there are alternative documentation loans available. One of the most popular ones is a bank statement loan. And we look at either 12 months or 24 months of either business or personal bank statements. And we look at the cash flow. We look at how much cash is coming into that account and how much cash is exiting that account. And we base that on an average of either 12 or 24 months. It's an alternative documentation loan, so there's risks involved. Yeah. Can we get it done? Yeah, we absolutely can, and we have. But it's a little bit bigger risk as well, because you've basically told us without telling us that you're very good or you have a very good accountant and you're not claiming all of your income. So we don't really know what your income looks like. So it's a calculated risk for us, and it's a bit of a calculated risk for you as the buyer. So your rates are probably going to be a little higher. You're not going to see additional costs. It's not like somebody's gouging you because that's the only route you can take. But you can expect it to take a little longer because there's a little bit extra digging that we have. And you can expect that your rate might have a little bit of a higher price tag on it because of that concern and or risk that we're taking on to fund that loan for you.
I think it's important to know too, and I always recommend this, but it's challenging to get in front of buyers early on in the game to give them this recommendation, right? But if you're going to buy in the next 12 months and you have not done your taxes yet before you buy, it's really important to talk to someone like Nate. I had to do this exact same thing. And just, making up numbers, maybe Nate will tell you, okay, what price point do you want to be at? I want a $500,000 home. Okay, great. Looking at last year's income, this year's income is going to need to net 150 grand. Okay, cool. No problem. And you made 200 and your accountant was going to give you 80,000 in deductions, bringing me down to 120. Thank God I reached out to Nate early, and now I can decide if I want to take the 80 in deductions, but Nate's going to tell me I'm approved for 4.25, not 500. Or I can only take 50 in deductions. I can get that 150 net, and now Nate will let me go buy a home for 500 grand, right? But at least I'm in control. And what he's saying is, if you decide to take the 80 grand in deductions, because that's what everybody wants to do, it's money, right? Nate can still help you, but it's either going to be at that lesser number, or you're going to do a bank statement loan and the terms are not going to be as appealing, right? So you've got a lot of different options, but it takes more planning and more coordination if you're someone running a business at a higher level. So that was incredibly helpful, man. Do you have anything else that maybe I didn't ask about that you want to throw out there as far as recommendations are concerned?
No, I want to make sure I kind of drive home the point that when you're looking at multiple lenders, the point that I want to make sure you take away as the viewer is that the difference maker is in what they are charging you, because there's so many different lenders that'll put different numbers on sheets in order to make themselves look like they're saving you thousands and thousands of dollars. But in theory, if my total cost, meaning in box A, the entirety of my cost is $1,000, I can't be off by more than $1,000 mathematically. And I think that's so important, because there's a lot of mortgage companies out there that don't do a good job of educating people that the difference makers just what their own fees are.
And guys, that's really simple, right? If you're shopping Bob and Nate, all you got to do is ask them, hey, can you shoot me a list of what my expenses are going to look like? And you can do that before you get pre-approved. You can look at Bob's, you can look at Nate's, you can even let Bob and Nate know that you're looking at Bob and Nate.
Yeah.
And then you compare those two and you'll see the distinct difference, right? And as soon as you see that difference, I wouldn't say that's the only thing you want to take into consideration, but it's certainly a big part of it, right? So check that out, and that's helpful too. I'll say a lot of lenders also, they'll do one or the other. If they know your shopping rate, they will buy the rate down by charging you points, and you don't even know it, right? Because you haven't asked for that form.
Right.
So now, yes, you've got the better rate, but at a cost, right? And then there's other people who are very fees focused, and so they'll up the rate so that they can take some of that cash and help you out on the back end. And now you're thinking, oh my gosh, my cash situation is awesome, but your rate just got higher. So over the span of 20, 30 years of paying that off, your payment out of your pocket is actually going to be higher, right?
Yeah.
Now, there's no right or wrong answer, right? Some of you guys are going to want a higher rate to keep cash in your pocket. Some don't care so much about cash. You want the rate. Neither answer is right or wrong, but you want to compare apples to apples when you're doing this stuff. So just getting that in writing, that's a phenomenal recommendation, man. Well, listen, I really thank you for coming on again. This was a great video. Guys, if you haven't checked out last week's video from last Friday, it was another phenomenal video. We've got another one coming up next week. We're doing a 3-part series here. Just a lot of great information. Nate, you're helping a lot of people with all this great, valuable information. So I just want to say thank you to you, my man.
My pleasure. My pleasure. And if anybody has any questions, like Joe said at the start of the show, go ahead and ask us those questions in the comments, and we will get back to you with an answer.
All right, guys, have a wonderful Friday and an even